May 6, 2010, 2:32 p.m. New York time. On Wall Street, an ordinary trading day was about to become a day etched into financial history. In less than 5 minutes, the Dow Jones Industrial Average, one of the most trusted barometers of the global economy, plunged nearly 1,000 points. Almost 9% of its value gone. Billions of dollars evaporated as traders watched their screens in disbelief. Stocks once worth hundreds of dollars were suddenly trading for pennies. Others spiked to impossible highs. Chaos, then silence. And then, just as suddenly, the market bounced back, almost as if nothing had happened. Almost. This was no ordinary market fluctuation. This was the flash crash, a financial earthquake unlike anything the modern world had seen before. And it didn't take days or hours, it took minutes. Pause. Music rises, a low pulse, cinematic tension. Narrator, stronger voice. But here's the question, who or what pulled the trigger? The traders? The banks? Or something far more silent, invisible, and faster than any human could ever react? The truth is darker than most people realize. Behind the blinking lights and the illusion of order, there were machines, algorithms, trading at lightning speed. Not thinking, not feeling, not hesitating. Just executing. Cold, ruthless, mechanical. And for the first time, the world saw what happens when machines, designed to make markets more efficient, spiral out of control. A glimpse of the future. A warning. A sign that Wall Street had unleashed a power it could no longer fully control. Cut to black screen. Text fades in. The AI tools that crashed the stock market. Narrator. Dramatic, steady. This is the story of how artificial intelligence began its quiet takeover of global finance. How lines of code grew into billion-dollar weapons. How decisions once made by human hands were handed over to algorithms faster than thought itself. From the flash crash of 2010 to the rise of today's AI-driven markets in 2025, this is not just a story of technology. It's a story of power, greed, and the dangerous truth of what happens when we let machines decide the fate of trillions. Music builds to a peak, then cuts suddenly to silence. Narrator, final whisper. And the scariest part, nobody saw it coming. Fade into the first scene. On May 6, 2010, the entire financial world was caught off guard. Within minutes, markets didn't just stumble, they collapsed. The Dow Jones dropped almost 1,000 points, the largest intraday point decline in history at that time. For a brief, terrifying moment, it felt like the system itself had broken. This wasn't caused by a war, or a terrorist attack, or breaking news. No natural disaster shook the earth. The culprit was something more subtle, more invisible. Lines of code executing trades faster than human eyes could follow. Cut to flashing code on a black screen. Streams of ones and zeros blur into stock charts spiraling downward. Narrator. The flash crash exposed the hidden machinery of modern markets. Behind every stock trade, every movement of the index were armies of algorithms. High-frequency trading bots, scanning, predicting, buying, selling, and canceling orders thousands of times per second. But on that day, these machines weren't stabilizing the market. They were feeding off each other. One algorithm's panic became another signal. Liquidity vanished. Stocks plummeted to cents while others soared to absurd prices. For a few terrifying minutes, the stock market wasn't human anymore. It was a battlefield of machines fighting machines. Scene shifts, a wide shot of Chicago's CME trading floor, then to New York Stock Exchange. Overlay graphics show order books disappearing. Narrator, calm explanatory tone. To understand why this happened, you need to understand how the market had changed. By 2010, trading wasn't just about men in suits yelling on exchange floors. It was about speed. Microseconds mattered. High-frequency trading firms, powered by algorithms, had become the new kings of Wall Street. They built systems so fast they placed their servers right next to exchange data centers, shaving off milliseconds that meant millions in profit. Instead of humans making decisions, machines were firing thousands of orders per second, reacting to the tiniest changes in price. This wasn't investing, it was a technological arms race. Quick montage, fiber optic cables underground, racks of servers humming, digital clocks ticking at impossible speeds. Narrator. And when one large automated sell order hit the futures market on May 6th, it lit the fuse. Algorithms that were supposed to provide liquidity, buyers to balance the sellers, pulled back sensing danger. Other algorithms saw the sudden drop and piled on. What followed was a feedback loop of panic. The machines weren't thinking. They weren't asking why the market was falling. They were simply executing the logic they had been given. Sell because others are selling. Protect capital at all costs. And with every millisecond, the crash accelerated. Cut to human traders staring helplessly, hands over their mouths. Narrator, somber. Imagine being a trader that afternoon. You see blue-chip companies, giants like Procter & Gamble, suddenly trading at 1 cent per share. Others, like Accenture, flash to $100,000 per share for mere seconds. Your stop-loss orders trigger, selling your positions into the chaos at prices you never imagined. Billions of dollars erased in an instant. And then, just as suddenly as it began, the market rebounded. Within 20 minutes, most of the losses were gone, as if the crash had never happened. But the damage was deeper than the charts could show. For the first time, the public realized Wall Street was no longer controlled by humans. Machines were in charge. Scene fades to black and white footage of congressional hearings. Senators questioning Wall Street executives. Flash headlines. What caused the flash crash? Narrator, serious questioning. In the days that followed, regulators scrambled for answers. Was it market manipulation? Was it a cyber attack? No. Investigations revealed that the true cause was the interaction of automated trading systems, algorithms designed to make markets more efficient, spiraling into chaos. A single large cell program collided with high-frequency trading bots, creating a chain reaction no one could stop. The financial system had become so complex, so automated, that even experts couldn't fully explain what had just happened. Montage, servers, code, Wall Street skyline turning into digital grids. Narrator, dramatic rising tension. The flash crash wasn't just a glitch, it was a warning. A glimpse of a future where artificial intelligence, not human judgment, would decide the fate of markets. Where speed and automation could amplify fear, magnify mistakes, and trigger financial earthquakes in the blink of an eye. And here's the chilling truth. Since 2010, the algorithms have only become faster, smarter, and far more powerful. What happened that day was not the end of the story. It was only the beginning. Music swells. Fade out. After the flash crash, one thing was clear. The market had changed forever. The illusion that humans were in control of Wall Street had shattered. Regulators rushed to implement safeguards. Circuit breakers that could halt trading if prices moved too far, too fast. But no safeguard could change the deeper truth. Machines now ruled the market. And the machines were only getting smarter. Cut to images of racks of servers in New Jersey data centers. Engineers walking through with ID badges. A digital map zooms out from New York to global exchanges. Narrator, intense. High-frequency trading firms had tasted power. Billions of dollars were made in microseconds, and Wall Street knew there was no turning back. So they doubled down. What began as simple rule-based algorithms, buy here, sell there, cancel if spreads widen, evolved into systems powered by machine learning. Instead of following rigid instructions, these new programs could learn patterns. They could adapt, predict, and react in ways no human ever could. They devoured mountains of data, price ticks, order flows, even the tone of financial news headlines. Some were trained to read earnings reports in seconds, extracting meaning and sentiment before a human analyst had even finished the first paragraph. Scene changes, footage of Goldman Sachs, Citadel, BlackRock headquarters, logos glowing on skyscrapers at night. Narrator, firm. By the mid-2010s, the giants of Wall Street, Goldman Sachs, Citadel, BlackRock, were no longer just banks or hedge funds. They were technology companies. They invested billions into artificial intelligence. Citadel built trading systems that monitored thousands of stocks at once, using AI to predict short-term movements. Goldman Sachs replaced entire trading desks with algorithms. What once took hundreds of traders was now managed by a handful of engineers and machines. And BlackRock, the largest asset manager on Earth, developed its own AI platform, Aladdin, to oversee trillions of dollars, spotting risks and opportunities across the global financial system. AI wasn't assisting finance anymore. It was finance. Cut to dramatization. A home retail trader sits at a desk, sipping coffee, as stock charts flicker across his laptop. Meanwhile, in a skyscraper, glowing servers process millions of trades per second. Narrator somber. And while retail investors, ordinary people, clicked buy and sell from their laptops, the reality was different. They were playing a game designed by machines, at speeds they could never hope to match. The rules of Wall Street had shifted. It was no longer human versus human. It was human versus machine, and the machine always had the edge. Montage, news clips of Night Capital 2012 glitch, showing frantic headlines like $440 million lost in 45 minutes. Narrator, sharply. And the machines didn't always win. In August 2012, Night Capital, a major market-making firm, unleashed a software glitch. For 45 minutes, its algorithms went rogue, buying and selling stocks at random. By the time humans shut it down, the company had lost $440 million. One mistake, 45 minutes, a company destroyed. It was a chilling reminder, speed cuts both ways. AI tools could create fortunes in seconds, or wipe them out just as fast. Cut to 2015 montage, chaotic charts of ETFs, mini crashes at market open. Narrator, thoughtful, reflective. Mini flash crashes began to appear. Exchange-traded funds, or ETFs, swung wildly at market open, driven by fragmented liquidity and algorithms tripping over each other. In 2018, another shock hit. A popular product called plunged, designed to bet against volatility, collapsed overnight. Investors woke up to find their savings obliterated. The market hadn't just moved, it had snapped, amplified by automated hedging systems and algorithmic responses that magnified every tremor. Every event was a new warning. Every glitch showed the same truth. The more we gave control to machines, the more fragile the system became. Scene changes, fast-paced cuts of Twitter feeds, Bloomberg terminals, AI dashboards scanning news headlines. Narrator, tense, building drama. Then came the rise of natural language processing, AI tools that could read. Imagine this, the Federal Reserve releases a statement. In less than a second, an AI has analyzed the language, detected whether it sounds more hawkish or dovish, and placed billions in trades before a human journalist even finishes typing the first line of their article. One eye misinterprets a phrase. Another AI reacts to its trades. A chain reaction begins. In an instant, markets can swing on nothing more than the placement of a word. Cut, archive footage of COVID-19 pandemic, empty streets, markets crashing in March 2020. Narrator, somber, reflective. Then in 2020, the world stopped. COVID-19 brought the sharpest market collapse since the Great Depression. This time, humans and machines panicked together. But even here, AI tools played a role. Trading algorithms amplified the volatility. Risk models failed to predict the scale of shutdowns. Machine learning systems, trained on past data, had never seen anything like a global pandemic. The result? Billions wiped out in weeks. The lesson? AI is powerful, but blind to events outside its training. It cannot imagine the unimaginable. Montage. Glowing neural networks. Charts, robotic hands typing. Wall Street skyline fading into grids of data. Narrator, rising intensity. From 2010 to today, the evolution has been relentless. Algorithms are faster. Models are smarter. AI is no longer just a tool. It's the invisible engine driving nearly every market decision. But with every advancement, the risk grows. Every new layer of complexity creates new failure points. Every improvement in speed narrows the line between profit and disaster. And if the flash crash was a warning shot, what happens when the next AI-driven collapse isn't over in 20 minutes? What happens when it lasts hours or days? Music builds, suspense thickens. Narrator, final line of section 2. Machines have taken control of the market's heartbeat, and the world has no idea what will happen if that heartbeat falters again. Fade to black, text on screen. To be continued. Wall Street has always thrived on risk, but in the age of artificial intelligence, the nature of risk itself has changed. It's no longer just about market cycles, recessions, or geopolitical shocks. It's about complexity, layers upon layers of algorithms, interacting faster than humans can comprehend. The flash crash of 2010 was a spark, but the fire it ignited has been burning ever since. Cut to footage of programmers typing, racks of servers, AI visualizations glowing in 3D networks. Narrator, steady, analytical. After 2010, regulators believed circuit breakers and oversight could keep the markets safe. But the reality? Safeguards can only do so much. They stop trading for 5 or 15 minutes when volatility spikes, but they cannot control what happens the moment the machines are turned back on. What we've built is a global system where algorithms don't sleep. They don't get tired. They don't hesitate. They process signals 24 hours a day, across stock exchanges, futures markets, currencies, crypto. One market moves, and the shock ripples through all the others. It's a web of interconnection. Fragile, tight. One thread snaps and the whole web shakes. Scene shifts. Traders drinking coffee, scrolling Twitter. Headlines flash. AI predicts Fed decision. Narrator, tense, building. In 2025, AI tools aren't just predicting prices, they're shaping them. Large language models, like the ones that now summarize earnings calls and analyze Federal Reserve statements, are feeding decisions into trading systems. Hedge funds use AI to scan millions of social media posts looking for hidden signals. Algorithms dissect the emotions of retail investors in real time. Every tweet, every headline, every word, all swallowed by machines that trade in fractions of a second. The market is no longer reacting to reality. It's reacting to data about reality. Data processed, filtered, and reinterpreted by artificial intelligence. Montage. Stock charts spike and collapse. Traders at home shake their heads. Retail investor forums scroll rapidly. Narrator, sharp. And the consequences? Flash crashes are no longer rare. They happen in miniature. dozens of times a year, hidden in the shadows of low liquidity assets. Retail traders never notice, but professionals see the fingerprints: sudden collapses, instant rebounds, anomalies that can't be explained by human behavior. It's the same story, again and again, feedback loops. One algorithm reacts to another. A sell becomes a trigger becomes an avalanche, and the avalanche doesn't stop until the machines decide it's time. Cut to Knight Capital office photos, headlines, 440M lost. Then fade to Citadel's skyscraper glowing in Chicago. Narrator somber. Knight Capital in 2012, ETFs in 2015. The 14 collapse in 2018. The COVID crash in 2020. Every incident carried the same warning. But the industry's response wasn't to slow down. It was to go faster. Hedge funds poured billions into AI research. Machine learning labs sprouted inside trading firms. They wanted more predictive power, more speed, more precision. The goal was profit. The cost? Uncertainty. Because every new model created new risks. Failure modes no regulator could fully understand. Scene shifts. Close-up on a humanoid AI face glowing in neon. Eyes scanning endless financial data. Narrator. Dark, gripping. Think about this. Right now, trillions of dollars move through markets every day. And most of those trades are decided not by humans, but by algorithms. Artificial intelligence is not just an assistant. It is a participant, a competitor, a predator. And while humans still believe they are in control, the truth is that the heartbeat of global finance now belongs to the machines. Music swells, building suspense. Narrator, urgent. The flash crash was only the beginning. A glimpse of what happens when speed and automation collide. But that was 2010. Since then, AI tools have multiplied. They've grown smarter, faster, and more integrated into every corner of finance. The question is no longer if another crash will come. The question is, when it does, how long will it last? Minutes? Hours? Days? And what happens if this time the rebound doesn't come? Fade to black. A single line of text appears on screen. Part 2 coming soon. Narrator. Calm, chilling whisper. In Part 2, we go deeper inside the machine. We'll reveal how AI tools are being built, the secret battles inside Wall Street's most powerful firms, and the hidden risks regulators don't want to admit. The flash crash was a warning. Part 2 will show you why the next crash could be permanent.